The Gateway to Southeast Asia, a comprehensive guide to the iShares MSCI Singapore ETF, EWS. As of February 20, 2026, the iShares MSCI Singapore ETF, ticker EWS, has emerged as a standout performer in the Asia-Pacific region. While many global markets spent the early part of the decade grappling with high inflation and geopolitical shifts, Singapore has doubled down on its status as a neutral safe haven. Earlier this month, on February 10, 2026, the Singapore government officially upgraded its 2026 GDP growth forecast to 2% to 4%, citing a massive global boom in artificial intelligence (AI) investment that is directly feeding into the city-state's electronics and financial sectors. For the international investor, EWS is the primary vehicle for gaining liquid exposure to this highly developed, stable, and strategically positioned economy. This guide explores the AI catalyst driving the fund today, the unique structure of its portfolio, and what you need to know before starting an investment this week. 1. The business case. Why Singapore? Why now? Singapore occupies a unique position in the global economy. It is a AAA-rated sovereign nation that serves as the financial and logistical gateway to the rest of Southeast Asia, ASEAN. The 2026 AI momentum. The most critical driver for EWS in 2026 is Singapore's successful pivot toward the AI infrastructure supply chain. The Ministry of Trade and Industry, MTI, noted that the 6.9% surge in growth seen in the final quarter of 2025 was largely powered by the electronics cluster. Semiconductor demand. As global tech giants invest over $660 billion in AI infrastructure this year, Singapore's manufacturing sector, which specializes in high-end semiconductor equipment and disk media, is seeing record orders. The One North expansion. The government's recent announcement of a new expanded AI park in the One North district is expected to attract billions in fresh foreign direct investment, FDI, throughout 2026. 2. Inside the fund, a heavyweight portfolio. EWS does not try to track every small business in Singapore. Instead, it tracks the MSCI Singapore 2550 Index, which focuses on large and mid-capitalization companies. This means when you buy EWS, you are essentially buying the national champions of Singapore. The financial powerhouse. Nearly 38% of the fund is concentrated in the financial sector. Singapore's big three banks, DBS, OCBC, and UOB, are the core of the portfolio. DBS Group Holdings, D05, currently the largest holding at roughly 23% weight. DBS is often cited as the world's best bank for its digital transformation. In 2026, it is benefiting from high interest margins and a surge in wealth management inflows from global investors seeking safety. Stability and yield. These banks are known for their robust capital positions and consistent dividend payouts, which provide a floor for the ETF's performance during market volatility. The new economy exposure. A defining feature of EWS in 2026 is its inclusion of C Limited, SE, and Grab Holdings, GRAB. C Limited, holding a weight of about 14%, C Limited, the parent of Shopee, gives EWS investors a direct line to the digital consumer explosion across Southeast Asia. Grab. After reaching profitability in late 2024, Grab has become a stable industrial/tech holding in the fund, representing the shift toward a more modernized, service-oriented Singaporean economy. 3. Performance and financial vitals. As of February 18, 2026, EWS is trading near $28.60, reflecting a significant recovery and growth trajectory over the past 12 months. Key metrics for investors. 1-year total return, approximately 31.5%. The fund has significantly outperformed broader emerging market benchmarks over the last year. Dividend yield. The trailing 12-month yield sits at a healthy 3.9% to 4%. Dividends are typically distributed semi-annually, June and December. Expense ratio. The fund carries an expense ratio of 0.50%. While higher than a standard S&P 500 tracker, it is considered competitive for a targeted international single-country fund. Valuation. EWS trades at a price-to-earnings ratio of roughly 17.6 times. Compared to the U.S. market, often 20 to 25 times, Singapore offers a relatively attractive entry point for a developed high-tech economy. 4. The fortress advantage, political and monetary stability. One of the primary reasons investors choose EWS is for risk mitigation. In an era of geo-economic fragmentation, Singapore's neutral stance is a massive asset. Political continuity. In 2026, the transition to the fourth generation leadership under Prime Minister Lawrence Wong has been seamless. The February 12, 2026 budget emphasized decisive AI-led growth, signaling to investors that the pro-business, pro-innovation policies of the last 60 years will remain intact. The currency hedge. EWS is denominated in USD, but its underlying assets are in Singapore dollars, SGD. The Monetary Authority of Singapore, MAS,
manages the SGD against a basket of currencies to ensure stability. Historically, the SGD has been one of the strongest and most resilient currencies in Asia, acting as a buffer for USD-based investors when other regional currencies are volatile. 5. Risks to consider before investing. No investment is without risk. For EWS in 2026, there are 3 specific watch items. Trade dependency. Singapore's trade-to-GDP ratio is one of the highest in the world. While the AI boom is providing a tailwind, a sudden escalation in global trade barriers or a sharp recession in the US or China would hit the industrials, 24% of the fund, and real estate, 9% of the fund, quickly. Concentration risk. Because the fund is capped but still highly concentrated, the performance of DBS Group and C Limited heavily dictates the direction of the entire ETF. If either of these 2 companies face a scandal or a major earnings miss, EWS will feel it disproportionately. Real estate sensitivity. With high interest rates expected to remain higher for longer through mid-2026, the REITs, real estate investment trusts within EWS, like CapitaLand, face continued pressure on their borrowing costs and property valuations. 5. Strategy. How to position EWS in your portfolio. For the retail investor in February 2026, EWS serves 2 primary functions. The tactical tilt. If you believe the AI cycle has another 2 to 3 years of growth, EWS is an efficient way to play the hardware and financing side of that trend without the extreme volatility of individual tech stocks. The income and growth hybrid. Because of the heavy banking and REIT exposure, EWS offers a higher yield than most growth-oriented funds. It is an excellent anchor for an international portfolio, providing a mix of 4% income and 10% to 15% capital appreciation. The entry point. The stock is currently testing its 52-week high of $29.65. Investors may want to look for a minor pullback toward the $27.50 support level to begin a position. However, with the positive GDP upgrades released last week, the momentum suggests that the current ceiling may soon become the new floor. Conclusion. A high-tech safe haven. The iShares MSCI Singapore ETF, EWS, in 2026 represents the evolution of a city-state. It is no longer just a boring collection of banks and shipping yards. It is a vital node in the global AI and digital finance network. With a robust 4% dividend, a government actively investing in the next generation of tech, and a currency that holds its ground, EWS offers a rare combination of safety and new economy upside. The verdict. If you are looking to diversify away from U.S. concentration while still keeping your money in a transparent, well-regulated, and high-growth environment, EWS is perhaps the most logical choice in the Asian theater today.